had the opportunity to sit down with mortgage agent Andrew Walters to discuss your home financing questions. What is a mortgage pre-approval, and why should people have one when house hunting?
So mortgage pre-approval is like the most important step in the house hunting process. It's the step that you should all lead off with. Ironically enough, most people don't, and they're guided to a mortgage broker or a bank rep as the first step after they've talked to a real estate agent or a home builder. Reason why you want to have a mortgage pre-approval before you get out and start shopping is it gives you that baseline. It lets you know like what can I afford. You're not going to be walking into a builder's office saying like, hey, I want to look at this home and it's $850,000 just to find out that the price tag on the monthly payment is not what you guys were hoping for, right? So it kind of takes a lot of the surprises out. You make sure you do all the planning up front, you give all your documentation. Right then and there, it provides you confidence. Like consumer confidence is paramount in this transaction, right? Because you're going into something it can be quite stressful, and you want to make it as even-keeled as possible. And the best thing for someone to do is make sure that they get their finances in order before they start shopping for a home.
Okay. What documents and information do you require for a pre-approval?
Varies from situation to situation. Just to be like real quick and brief on each different situation. Typically, like a salaried employee would just be a job letter, pay stub. Obviously you need identification, all that kind of stuff. For a self-employed individual, if you're a sole proprietor, master business license, last 2 years T1 generals, last 2 years notice of assessments, make sure you don't owe the tax man any money. For someone that is like in a bonus structure, like in a sales role or, salary plus commission or any sort of stuff like that, you'd be looking at job letter, pay stub, last 2 years T4s, for the documentation. And then, like I said, like you need your ID, void check, and, a general idea of like what you want to put down and where the money's coming down from for the down payment.
Okay. Once complete, how does a pre-approval transition into a live mortgage?
Yeah, so a pre-approval is like, you got to think of it as there is 3 pillars to a pre-approval, right? You have the income, you have the credit, right? So pulling the credit, looking at the credit is super important as well. And then you have the hypothetical property. The only thing that's going to change from a pre-approval into a firm approval is going to be that hypothetical property. Instead of being like 123 Somewhere Street, you're going to be like 12 Rosecrans Drive, and it's going to be this price, right? That's the only thing that's going to really change. Now, to be, kind of get into the weeds a little bit, the property, just because you're pre-approved, right? It's like the bank is saying like, yes, Joe, I want to lend you money, right? That's all well and good. They also want to be certain about the property that you're buying. So if you bought something from a builder, new build, 99% of the time you'll be okay. But if you look at like something that's, a fixer up or any sort of stuff like that, they'll be like, yeah, you know what, Joe, we like you, I want to lend you money, but the property isn't what we're hoping for, right? So the property is the main thing that changes from a pre-approval into a firm approval.
Okay, great. What is the mortgage stress test and who does it apply to?
Oh, everybody. The stress test is implied by the government. So OSFI, who's the Office of the Superintendent of Financial Institutions, they implemented the stress test to ensure that Canadians can afford higher interest rates. So what the stress test is your contract rate. So the contract rate being like, let's say you're getting a 5-year fixed at 5.09%, let's just say. The stress test is the contract rate plus 2%, right? And that goes into all your debt to income calculations, like your gross debt service ratio and your total debt service ratio. So they don't use the contract payment. You have to show and prove that you can afford an interest rate 2% higher than what you're currently paying.
Wonderful. Can you tell us about any programs available to help first-time homebuyers afford their first home?
Yeah, for sure. So first-time homebuyers actually have a lot of incentives in Canada, which is kind of nice, right? One of I'll go over the old ones first. You can use your RSPs for your down payment as long as you pay it back within 15 years. Maximum that you can withdraw from your RSPs is going to be $35,000. Okay, as long as you pay it back in 15 years, everything's all good. The other thing is that you're incentivized by the government to purchase a home as a first-time home buyer. They'll give you a land transfer tax rebate. So what that ends up being is a $4,000 rebate instantly at the lawyer's office. So that works out to be, the first $368,000 of a purchase price is covered on that rebate. Anything over and above as a first-time home buyer, let's say, you know, you bought a home for $450,000. Let's say the land transfer tax on that was $4,800. You'd be paying $800 in land transfer. The other thing is that you have a tax credit from the government as well. When you go to file your taxes the following year, you say like, hey, you know, CRA, I bought a home this year. It kind of offsets I like to say it offsets the cost of the lawyer, because they'll give you about $750 to $800 back as a tax credit as a first-time home buyer. They just recently came out with a new first-time home buyers savings account, which is a little bit different than the RSP and things like that. You can pull the money out tax-free. You get a lot of tax incentives and things like that. Best thing to do if you're looking to open up an account like that is talk to your local branch and get the ball moving on opening that account.
When you get approved for a mortgage, you can typically hold your interest rate for a certain period of time. Can you explain how this would apply to a pre-construction home?
Yeah, okay. So on a pre-construction, usually typically the length of time to close is quite long, right? So when you get a rate hold on a pre-construction, when you sign for the pre-construction, you're gonna have 5 days to fulfill your financing. Your rate's gonna be held for 120 days from that point in time. After which, as time goes on, you are going to re-extend that pre-approval, or your broker, your bank should be re-extending that pre-approval to hold the rate for another 120 days. And that process repeats itself until the closing day. Ideally, you'd like to get somebody that's switched on, so if they know interest rates are increasing, they're going to extend it before that increase actually happens, to kind of negate, you know, a lot of the interest rate fluctuations that are happening in the marketplace.
Okay. How do you know if a fixed rate or variable rate mortgage is right for you?
That depends on each individual. Currently, right now, it's very hard to incentivize someone to take a variable rate when there's so much volatility in the marketplace currently right now. Depending on your personal financial situation is going to kind of dictate what type of product is best for you. And everyone's different. It's kind of trying to find the shoe that fits, right? I'd have to talk to somebody and discuss their financial strategy and what they're looking to achieve in real estate in order to kind of really hammer out that question and really answer it. But everyone's different. Everyone's going to have a different situation that provides a different financial goal through the mortgage that you choose.
When buying a pre-construction home, should you go to the top end of your budget?
I usually recommend that people do not go to the top end of their budget. Typically, people want to do some sort of upgrades, right? Like that's going to be the fun part of buying a new build home, right? From the builder, you get to put your own stamp on the home, right? So you want to make sure that you leave a little bit of room in that pre-approval to account for those upgrades, because that's going to eat into that pre-approval. So like, let's say you're pre-approved for $700, right? And you bought the home, price tag $699.9, and then you want to do $50,000 in upgrades, right? That's going to kind of create a little bit of an issue unless you have the cash on hand that you want to pay for it. So in that instance, like maybe you buy something for $649.9, and then you want to do $50,000 in upgrades, then you can, it's allocated in your budget with a pre-approval of $700,000.
When buying a brand new build, does it need an appraisal? If so, when?
That's a good question. It depends on each individual's, again, personal financial situation. Typically, we do not need an appraisal when you're putting less than 20% down. Reason being is that the money's insured through either one of the 3 insurers in Canada, Sagen, CMHC, or Canada Guarantee. When the money's insured, the bank doesn't really care about the value of the home, because in the event that someone were to default, the money is given back to the bank by the mortgage insurer. In the event that someone has 20% or more down, right, then an appraisal would be required. Not all the time, but I would say 80 to 90% of the time. 100% of the time if you're buying a rental. If you're purchasing the property from the builder as a rental property, guaranteed you will need an appraisal. 8 out of 10 times when you're putting 20% down, you're going to need an appraisal. And that's going to be dependent on the bank that you go to, right? And also the comfort level with the price that you're paying. And what the appraisal does is it makes the bank feel comfortable to lend you the money, knowing that the home is worth what you're paying for. And that's typically done on the pre-inspection delivery date, the PDI date for you guys.
Builders require a deposit up front for a pre-construction home. How does that work with your down payment?
So the deposit goes right towards the down payment. So what ends up happening is that the the client or the customer will give you guys the deposit. The deposit's then held in trust by you guys, the builder, I should say. The builder then holds it in trust. At the end of the transaction, right, your lawyer and the buyer's lawyer are gonna kind of meet up and they're gonna talk and they'll say like, okay, well, you know, Mr. Smith has $40,000 in a deposit, right? That's gonna be allocated towards your down payment at the time of closing.
What does the financing process look like for a buyer from accepted offer to closing date?
Yeah, so cutting out the pre-approval, you've already got pre-approved, all that stuff is all well and good. Once the offer is accepted, ideally you'd have your bank professional or your mortgage broker in receiving of the documents. They would then put your file together, they would submit it to the bank for the firm approval. From there, you know, if an appraisal is required, that would happen closer to the closing date, obviously because of pre-construction takes some time to build. You'd hand in new documentation, so new income documentation, you'd have to have your down payment documentation, all your ID identification, all that kind of good stuff. From there, once everything is signed off on, you have a long waiting period, right? You just sit around and you wait for the closing date. I just usually call this dead time. A lot of people feel that they should be doing more, but in actuality, you know, the financing window typically is 7 days, and typically it's all done within that 7-day window.
Can you explain some of the advantages of porting your mortgage and what exactly that strategy is?
Yes. So super important, when you are choosing a mortgage product right out of the gate, you want to ensure that you have the option to port, and you want to go with a lender that has a very robust porting policy. In the event that you are able to port, right, the porting, all it does is you're taking the mortgage from property A and you're going to move it to property B. You're keeping everything intact with the original mortgage, so there's no penalty, no change to rate, all that kind of stuff. Usually what ends up happening is that people buy a home, they're upgrading, they owe $400,000 on their mortgage, maybe they're taking a new mortgage, in total they need $550,000. So what ends up happening is that they blend your interest rate together. So let's say you had 2.99% on a 5-year fixed, and let's say, you know, the going rate right now is like 5% on a 5-year fixed, let's say. They would blend those two interest rates together to give you your new interest rate, right? More of the money, let's say you owed $400,000 and you only needed another $150,000 for the new mortgage, more of that money is going to be allocated to the $299,000 that you already had. So you're going to have like a much lower interest rate than someone that's not porting a mortgage. I can't stress this enough though. Just because you have a mortgage on your property right now and you can afford to pay it right now, doesn't mean that you will qualify to port to the new property. Porting, you have to requalify at today's rule set. Even if you got the mortgage 20 years ago, you have to requalify at today's rule set to be able to move that mortgage from property A to property B. In today's climate and marketplace, if you have a fixed rate, 100% you should be looking at porting it, because it's going to lower your overall cost of borrowing significantly.
Thank you for your questions. And if you have more home financing inquiries, you can email Andrew at andrewwalters.ca. And as usual, check us out at phoenixhomes.ca.